The first and the foremost rule of any strategy designed to follow the trend is to determine the direction of the current market trend. Trader can do this in several different ways. In order to determine the direction of the current market trend, the multi-timeframe trading strategy utilizes an integrated approach with the simultaneous application of several analytical tools. The first tool is a graphical analysis, that is the sequence of price highs and lows. The second tool are the moving averages, that is the mutual disposition of the three pairs of moving averages. And the third tool is the amplitude of the price fluctuations, that is the amplitude of price swings that develop in the direction of the market trend and its correction. The easiest way to determine the direction of the current market trend is the visual method, which does not involve the application of any indicators or lines. Trader identifies the highs and lows just looking at the charts. If the highs and lows are rising all the time, then the current market trend is up. Accordingly, if the highs and lows are falling all the time, then the current market trend is down. If neither of the above conditions is met, then the trend is sideways. Here's how it looks on the chart. To begin with, trader should locate the key highs and key lows on the chart and mark them as H and L. Trader should define the key points in such a way as to satisfy the following condition. The key high must be located between the two key lows, and vice versa. The key low must be located between the two key highs. If on the selected chart, each subsequent key high and key low are lower than the previous, then the trend is down. And vice versa, if on the selected chart, each subsequent key high and key low are higher than the previous, then the trend is up. In addition to the visual method of determining the direction of the trend, trader can also use technical indicators. As I mentioned above, to solve this problem, the multi-timeframe trading strategy uses three pairs of moving averages built on three different time frames. All moving averages used in the strategy belong to simple SMA or exponential EMA type. The number of time intervals used for the calculation of moving averages equals 200. The strategy uses the following rule. If the three pairs of moving averages are arranged in a sequence, as shown in the diagram on the left, then the current market trend is down. Such an arrangement of moving averages is called bearish perfect order. Accordingly, if the three pairs of moving averages are arranged in a sequence, as shown in the diagram on the right, then the current market trend is up. Such an arrangement of moving averages is called bullish perfect order. At last, if the pair of green and blue color moving averages is located on the opposite sides of the pair of red color moving averages, then the current market trend is sideways. Very often, when a downtrend or uptrend is formed, moving averages may act as support and resistance lines. Every time the price touches these lines, it bounces off and continues to move in the direction of the prior trend. It moves down, as shown on the left, or it moves up, as shown on the right. Of course, the market price movement does not always perform in such a beautiful manner. Sometimes the price line breaks through the moving averages. However, the main rule of the trend is not violated. Each new key high and each new key low are above the previous ones in the case of the uptrend. And each new key high and each new key low are below the previous ones in the case of the downtrend. That is, even in the case of the moving averages breakthrough, the condition of downtrend or uptrend is clearly seen. So, trader can use key points and moving averages for the purpose of defining the direction of the current trend. And this is true for the long-term, medium-term and short-term trend. Or, in other words, the same rules apply regardless of the time frame, 10 minutes, 1 hour or 4 hours. The third criterion for determining and confirming a trend is the range of price fluctuations. or, in other words, the size of price swings that go in the direction or against the current market trend. If the size of the price swing, which goes against the trend, has the amplitude of more than 100% of ADV of the selected financial instrument, then it means the beginning of a correction. To estimate the amplitude of such price swings, it is recommended to use the Fibonacci grid, as shown on the slide below. The next two slides show the examples of the uptrend and downtrend. Here, both in the first and in the second cases, the three conditions for the existence of the market trend are met. Firstly, there is a clear sequence of highs and lows, where each subsequent high and low are lower than the previous one in the case of the downtrend, as well as each subsequent high and low are higher than the previous one in the case of the uptrend. Second, the relative disposition of the moving averages generates a signal called perfect order. Third, the price swings which go against the trend do not exceed the amplitude of 100% of ADV of the selected financial instrument. It is obvious that in a situation where the market stays in a clear uptrend or downtrend, any trader must establish a long or a short position. However, when the market begins a correction, traders should take a wait-and-see attitude and be ready to open a long or a short position immediately after the correction is over.